Hey everybody, Economic Ninja here. I hope you're doing great. Want to talk today, sitting at the hotel, got a little bit of time before I go off to my first meeting of the day, and I wanted to talk to you today about how to recognize when the Federal Reserve is about to pivot. Now, first I want to say there's two types of pivots, and when it comes to interest rate, and I've been through a few of these already, a few cycles, and I have identified some very common traits using human behavior. And there are three different levels of this information that flows through to the street before. And when I'm referring to the street, I'm talking about the average everyday retail investors. And this is very recognizable and very easy to sort of predict, okay? And then we'll talk about my predictions coming up with where the Fed's going to go in the middle of this not only interest rate hiking cycle to combat out of control inflation that is truly out of control now. The Federal Reserve has been trying to control it. They misstepped a couple of times and they lost control of it. Of course, everyone's blaming, the global pandemic, but there's some pretty easy steps to figure out or watch signs when they're going to pivot. All right. So first off, there's two types of pivots. There is the pivot, what everyone is expecting right now, when the Federal Reserve goes from raising rates to lowering rates. All right. But I want to explain that the first step to go from raising rates to lowering rates is a pause. All right. There has really only been in my, as far as I've looked back on Federal Reserve rate charts, I've only seen one time when they went just about immediately from a raising to a pause. From a raising to a lowering, and that was in 2018. I believe it was around December. And that was because they were being called on the mat for what they were doing, right? That they were going to break the backbone of the economy. And in the meantime, in the 3 months prior to them lowering rates, the Dow Jones had lost like 19 or 20% of its value, right? Usually, primarily, they go from raising, then they pause at those high rates after, and they start pausing because something is broken, right? The economy is now drastically affected by the interest rate hike cycle. So things start to break, either it be housing sales, the stock market, retail sales, whatever. There's a myriad of metrics to be able to measure. But they pause, and then when things go really bad, they start to lower. Okay. Now, the other type of rate cycle, is when you go from a low rate environment to now making a decision. The Federal Reserve goes, okay, now we are going to plan on bringing rates to a more sustainable or normal level, right? And a lot of people don't understand that both of these cycles carry the exact same type of human indicators, the indicators that show you when is coming next. And I go into this in much more detail when in my real estate course, because it's so vital for real estate investors that look to pivot and move into real estate to take advantage of a collapse, a crash in market prices, or those that are like when I started real estate, diving into real estate because rates were dropping low. And I knew that eventually those prices of homes would dive higher. So there's two different times. When you're going to sell your homes, you're getting out because there's going to be a crash. You're getting out, selling your properties, and then you're diving in when rates start to lower. Okay, so we're going to use news, but we're going to talk about the three levels. First off, the first level is the street. Now, the street is the news media, the media that are coming out and talking about their ideas of when they feel reporters what rates are going to do next, right? The next level is institution. Sorry, there's four. I totally messed up. There's four. The street is what people consensus, op-eds or editorials, people that are writing in, giving their opinions. The common man and woman that are the retail investors talking about what they believe their opinion is going to be, what the Federal Reserve is going to do next with interest rates. Then you have institutions like Goldman Sachs and large institutions that have people, they get paid lots of money to forecast these things, right? And you see them come out and give their consensus. And we're seeing that right now in the news. The next two levels lies in the Federal Reserve, okay? So you have ex-governors that start speaking about their opinion, ex-Federal Reserve governors that talk about where they believe the rates are going and how the Fed either did a good job or did a bad job. And then you have the current governors that talk. Now, this is where I start talking about the talking heads. These are the current board of governors that work for the Federal Reserve, and they give press conferences as well. They give interviews and they talk about their opinions. And we see that in the news right now, where they believe rates are going. Is the Fed going to pause? Is it going to lower? Is it going to raise? Okay. Then you have the ultimate top. You have the chairman of the Federal Reserve, which currently is Jerome Powell. And that is obviously the decision maker. Now, you will see him come out every once in a while, give a press conference on what he believes is the status of the economy. They will always cover it with, we don't have current, but based on the information we have, they like to leave this very open-ended. We believe that monetary policy is going the correct way. It's never going the wrong way, just so you know. And we believe that we're on a correct path or a good trajectory right now. They're always trying to ease you into what's going to come next. So let's give some examples. And this is why it's so vital, because right now we are in a pivotal point with the banking system collapse. The banks are crashing, and we're talking about regional banks. We haven't moved into large national or international banks yet. However, we do have Credit Suisse collapsing in Europe, which is going to have a contagion effect here. Okay, it is going to affect, Credit Suisse will affect some of our international banks, all right, large banks. So let's check this out. Let's just look at the headlines. You see the street talking out of Barron's why the Fed is likely to stick with the March rate hike. Okay, now we're just going to talk about headlines. Okay, Reuters, CNBC. This is 2 days ago. Something broke, but the Fed is still expected to go through rate hikes. All right, now let's talk about some governors. Now, we have other also professionals in the field, like Wharton professional Jeremy Siegel. He's blaming, he's out there railing against the Federal Reserve and what they're doing, why the raising height cycles are hurting the banking system right now. But you look here, former top official, Fed official calls for the world's two most important central banks to pause plans to raise rates. Now that's an ex-governor, right? Talking about you need to start planning right now to pause rates because the system broke. The regional banks are crashing right now. We're having a hard time. We're going to be putting probably trillions of dollars into making not only customers solvent, but also holding them up, propping them up. We've given them a credit facility to come and run to us in the middle of the night, hidden, like secretly. Say, hey, I need $25 billion. Okay, here's $25 billion. And the Fed's not going to tell you which banks it is because they are now afraid, and they've said that we're not going to divulge what banks we give money to for 1 year after the closing of that credit facility. Okay, so this is very serious. So you have a former Fed governor coming out and saying, you guys need to start, we're calling for the Fed to come up with a plan right now to start pausing rates. But it doesn't tell you right there that there's going to be pause. And I want you to understand that these people, this whole group, they know what's going on. They are the smartest people in the room because they are the ones literally with the switches. They are controlling everything, okay? So they all know. So what they do is sort of a planned attack. The Fed governors come out. They already know what we're going to do. We know the consensus. We were all in the last meeting. So the Fed governors come out and start talking ahead of time. And they start talking. One will say, yeah, I believe that we should see us start to pause. I'm giving just a hypothetical right now because I do not believe, I'd be very surprised if they pause right now, okay, in the month of March. That's my call. I could be wrong. I've been right. I've been wrong. But I can guarantee you this: I do not believe that the Federal Reserve is going to lower rates this month. Okay, I believe that it's 20% they're going to pause, 80% that they're going to do another rate hike, and if they do, it will more than likely be a 25% rate hike in lieu of the recent events, instead of a 50 basis point hike like the street was expecting a couple of weeks ago. Okay, so we see these times where you can actually start to see the consensus of all four layers, right? The street starts to agree that, oh, it's time to pause, everything's destroyed. The bigwigs in institutions like Goldman Sachs, JP Morgan, those investment houses, they start saying, you know what, I believe the Fed's going to pause, or we're calling for the Fed to pause. Then you see the Board of Governors start talking about it, and then finally the head of the Fed, Jerome Powell, would come out and say, we're going to lower rates, all right, or we're going to pause. It has to work in that order. It always goes backwards all the way up to the top, right? The street starts screaming, have mercy on us. Then the investment houses start screaming, have mercy on us. Then the Board of Governors say, yeah, it looks like this is the time. Then the Fed. And you're talking about a month to 2 month process of news flow to finally get you as the investor to the point of knowing they're going to pause, or they're going to lower. And that's very crucial. And like I said, I go into much deeper, take this much deeper in the real estate course, because you need to identify these cycles, not because you're going to dive right in the second the Fed pivots from a lowering point to we're going to start raising, or from a high point and we're going to start lowering. But you need to see these cycles and then be able to confirm that the Fed is in fact in a monthly or a multi-point time frame of either raising once here, once here, once here, once here. You know that this is going to stick, that this cycle is going to stay, or to the downside where they start to pivot and start dropping rates. You want to make sure, just like what happened in December, a lot of people got caught on the wrong side of that trade because they thought the Fed is about to start, they're going to start slowing their rate of increase. So they went from 75 basis point hikes to 50 point basic hike to now 25. And then what happened next? 50. We've got to actually look at the history and go, okay, where is the Fed going? Is this going to be a constant downhill interest rate environment or a constant uphill? Because that is going to drastically affect your investments. It's going to, from everything from stocks to real estate, and really primarily real estate. So I wanted to sort of give you a brief overview. You know, I don't have notes or anything like that. I'm just talking from the heart and my experiences, and show you that it's so vital and for you to pay attention to not just one source of news, but take in the whole source of news and all of the levels from the street to the head of the Fed. They are all telling you what's coming, but at different time points and from different parts of the country and on different news outlets. You have to take all of that in to be able to properly gauge where we are next in the real estate or interest rate cycle. Guys, I hope you have a great day. The Economic Ninja is out.